Hi students, Professor Orenberg here, and welcome to our series on organizational choices. This will be a series of videos covering which type of business association to form and why. And we're going to break this apart into a series of smaller videos to make it a little easier to remember all of the details that are involved in the study of business associations' organizational choices. So let's get started. This series is going to proceed with 6 videos. First, we're going to introduce the process of selecting a business entity by reviewing 7 issues that are going to come up time and time again when deciding what entity to choose. We're then going to discuss the 4 major types of organizational choices: general partnerships, limited partnerships, C corporations, and limited liability companies, in the context of those 7 issues, forming a matrix of effectively 4 entity choices by 7 issues. And then in our 6th video, we're going to summarize everything by briefly noting some alternative organizational choices that can be used for professional groups, and then summarizing the 7 issues across this matrix of 4 types of organizational choices. And in that process, you will learn the differences between the 4 major organizational choices and when to select one or the other for basic business planning purposes. A corporation's one of the best known types of entities and one of the most widely used because it has a very specific structure which can be beneficial for organizing large groups of people in a business. The nature of a corporation is designed to separate ownership from control, meaning that the shareholders, who are the ultimate owners of the corporation, get the benefit of any residual profits, do not run the day-to-day activities. We have professional management who are in charge of that. This is very different from a partnership, where the partners, who are the owners, are also generally the day-to-day managers. So unlike a partnership where we expect the managers and the owners to be identical, in a corporation we expect the managers and owners to be separate, creating a hierarchy and a separate type of structure where we have several layers. Corporations likewise are meant to exist forever, unlike limited partnerships, which tend to exist for a period of time while there's an active investment and then end when the investment is concluded. This perpetual existence allows some corporations to amass an amazing amount of wealth over a period of time. That is mitigated somewhat by the fact that corporations are double taxed, meaning corporations are entities that are themselves taxed when they earn profits, and then shareholders are taxed a second time when they receive distributions from corporations. There are some ways around this, but the question is whether or not the tax is worth all the benefits. And one of those benefits is that this is another time-tested structure. It's existed for hundreds of years in various forms. We've had the modern form for well over 100 years. Delaware law is very advanced, as many other areas have very advanced law. So a lot of benefits to selecting a corporation. But again, it's for a very specific purpose, typically organizing a significant amount of capital and labor for a business that is operating as an ongoing concern and not simply an investment company. There isn't a uniform corporate law, and there isn't really a solid attempt. There is the Model Business Corporations Act, but the most important state in most people's mind in terms of corporate law is Delaware, and Delaware has not adopted the Model Act. And so really we don't have a uniform corporate law to speak of. We have Delaware law, we have the Model Act, and we have a couple other major states like California that play big roles in our corporate society. The map here shows the largest corporations in each of our 50 states, and it's really meant to just indicate that there is a wide variety of types of corporations and laws that govern them. That said, let's go over some general principles and talk about the 7 issues that may come up in deciding whether a corporation is the right business entity choice for your client. The first issue coming up is formation, and a corporation can only be formed by a filing. There are some equitable concepts called de facto corporation, which is sort of the equitable exception to this, but in general, just like the limited partnership and the LLC, a filing is required to create a corporation. It's certainly not going to create it by mistake. You can file a corporation, create a corporation in any state, no matter where you reside, and that gives you the benefit of selecting the state laws that you chose to have your internal affairs governed by. But that also means you may need to have a registered agent who can accept process. So if you're sued You have to be able to be sued in the state in which you're incorporated, and so someone has to be there to accept process. So you do need to indicate that process agent. The corporation is formed by a mere filing of articles of incorporation. Can be formed either by the promoters, the individuals creating the company, or sometimes by an attorney who is creating it on their behalf. It'll include the corporate name, the number of authorized shares, and the name and address of the incorporator. The corporation could also be limited to achieving a certain purpose at its formation. This is typically only used when it's a nonprofit corporation. For-profit corporations are generally formed for, quote, any lawful purpose. There may also be some limitations or abilities of management listed in the articles of incorporation as well. Maybe powers to indemnify the management, etc. Both the Model Business Corporations Act and the Delaware General Corporation Law require filing. Big difference is really just in the name. Under the Delaware law, it's called the the certificate of incorporation, and the MCBA calls it the Articles of Incorporation. But they're the same thing, and they have very similar requirements. Shareholders of a corporation enjoy limited liability. It's one of the major reasons to invest in a corporation. So if you have stock in Microsoft Corporation and Satya Nadella is somehow indicted in some type of terrible bribery scandal and the company owes $20 million to a foreign country, they're not going to be coming after you personally as a shareholder of Microsoft. However, there is a doctrine called piercing the corporate veil. It also applies to limited liability companies, so we can pierce the limited liability company veil that can expose shareholders to unlimited liability in certain instances. In addition to liability of directors, shareholders, in addition to liability of shareholders to outside persons, such as when there is veil piercing, again, that's the exception, not the rule. Shareholders generally are not liable beyond the amount that they have invested. The directors also have a liability, duty to the shareholders. And if they breach their fiduciary duties, the shareholders can sue the directors in a variety of different processes as well. The officers also have some liability to shareholders as well in this hierarchical structure. How is a corporation managed? Management of a corporation is centralized. The key concept in a corporation is hierarchy, that there is a centralized board of directors that are professional management, and they are separate from the owners, the shareholders. The board's job is to approve extraordinary transactions and to appoint the officers, and the officers, such as the CEO, the chief executive officer, are going to run the day-to-day operations. The board is going to be nominated by the shareholders, and the shareholders generally vote based on basically on pro rata based on their investment. So the more money you invest in the company, the more votes you have. If you have invested 90% of the capital, you'll be picking the board yourself. There are different rules in terms of how voting can proceed. We'll talk about those in future lessons. It can be straight, it can be cumulative. But for today's purposes, keynote is that the control rights are going to really identify that separateness, that hierarchy. The shareholders own the company, but they do not control it, not beyond voting for the board. And the board, while they're the ultimate situs of control, they really only meet to handle extraordinary transactions. They, in turn, are going to nominate executive officers to run day-to-day operations, further separating ownership and control. Again, the theme of corporations is that separation of ownership and control, which can be desirable and is very much in opposite to the partnership structure. Financial rights are generally distributed pro rata, meaning the percent that you own reflects the percent of dividends you're entitled to. Unlike partnerships where it's one person, one share, in a corporation it's usually $1 invested, one unit or percentage. So if you've invested $1 million and another person invested 10,000, you'd be entitled to 100 times more of the return on the investment because you invested 100 times more. Only the board, however, can declare an event called a dividend event where the profits are actually distributed to shareholders. And that doesn't actually happen very often because of tax reasons, because we incur double taxation at that point. So you might ask, why would shareholders invest in a company if they're not going to be receiving profits? Well, some of them might be buying the stock to sell the stock later. So you can buy stock and resell it later, which will come up in our liquidity discussion. Corporations are generally designed to last forever, to have a perpetual existence. They can be dissolved. A dissolution requires board recommendation and shareholder approval, at which point the corporation can be wound up and its affairs can be tied out and its existence terminated. But corporations don't generally have a lifespan or an expiration date. They're generally designed to last indefinitely. And so they can be dissolved, but hopefully last a very long time, and certainly can last more than a human lifetime. In theory, stock in a corporation is freely transferable, but in practice, many transfer restrictions exist, both private and public. So on the private side, although the general default is that shares can be freely transferred, a corporation is free to put restrictions on transfer and to limit liquidity of its shares for any number of reasons. Like if you have hired founders to start the company and you've paid them in stock instead of cash and you want them to stay around, you can bind those shares to them and make it hard for them to sell for a period of time. Of course, something you can't sell is less valuable than something you can, so that creates a problem called a liquidity discount. But there are good reasons not to allow founders to sell their shares and walk away from a business they're supposed to be running. Likewise, you may not want your investors selling their shares. There are limits to how many shareholders one can have and, for example, remain a private company. And going public is very expensive, so there could be good reasons not to want to do that. In addition, there are public restrictions, also known as securities regulations, over the transfer of stock in a company. Stock is an investment. It's governed by the 1933 and the 1934 and the 1940 Acts, and as a result, there are a number of legal restrictions on the transfer of securities. So while they may seem transferable in theory, there may not be a market, there may not be a buyer, there may be restrictions in the bylaws, there could be restrictions in the Articles of Incorporation, there could be private contractual restrictions among the shareholders, and then there are going to be securities law restrictions around resale of stock. So in reality, although seemingly liquid, it's not entirely true that stock is totally liquid in all cases, because there are many ways for it to be bound up. And finally, a merger is relatively simple. It involves the filing of a certificate of merger. Mergers and acquisitions is a great class to take, but it is a whole class on its own. Corporate mergers are a source of billions of dollars toward the GDP every year and are a huge area to focus on, well beyond the scope of today. Very briefly, you file a merger by creating a certificate of merger, and that can simply put companies A and B together, but there are many other ways to do it, like creating a merger subsidiary and merging one company into the subsidiary, which is then owned by the parent. You can do a reverse triangular merger, you can do a two-step merger. There are asset sales, all sorts of ways that it can be done. But the short version is that it does require a certificate of merger, and that merger needs to be approved by the shareholders. So you need a plan of merger and approval by a majority of shareholders and the board. And that does limit the ability of companies to merge somewhat, but not nearly as limited as with a partnership. So you see a bit more liquidity here as well. Up next, we're going to talk about limited liability companies, which is our fourth in our series of 4 company entities to think about when deciding what type of business organization to form.